We're live.
We're live. That's scary. It's almost like people are watching us and we're supposed to super insightful, intelligent things for them to say to solve all of their life problems. All at once. That's how that works.
I don't know, man. I just work here.
So tell me, you just work here? Okay. All right. In your professional opinion, tell me how to solve all of my life problems.
Quit worrying so much about what other people think and just do the things that bring you joy. Unless that thing that brings you joy brings harm onto other people.
And there you have it.
Simple as that. Done. Mic drop. End of video.
Don't do that. They'll hear that. Are you ready?
Ready.
Is that going to make it to the video?
Maybe.
Maybe it will. Uh-oh. All right. Hi, I'm Tom.
I'm Brian.
And we are the Dividend Dudes.
There we are.
In this video, it's the time of month where we're going to be talking about the stock that we're purchasing. We're going to do the purchase once per month, and we are on month number 2. We have not yet gotten a dividend check from AT&T, so we can't spend that massive 75 cents, that we'll be getting. But we're buying another stock, and this is based on, again, in video 2. We apologize for the first videos. We did not have the microphone set up we have now. But if you go back to that video, we kind of got into some of the averages at the time. We might have to do that annually or refresh that biannually just so people know these are the averages. So on that number, we buy $400 per month in stocks, and all of them pay dividends. And since our last purchase, the stock market is really not done well.
No.
Yeah, we want to talk about that a little bit. It's down about 25% since the inception. Our stock that we purchased is up 2%, which should be quite the statement. But when you buy stocks, we are not buying these stocks based on the fact that we want to buy low and sell high. We're buying them based on an income methodology or mindset. So we're going to take that 25 cents from AT&T and, in this case, we're going to reinvest it. But if you wanted to, and you paid your capital gains and taxes, you could take that and go get 75 horsey rides at Meyer.
Or a cup of coffee.
Or a cup of coffee. You can get a coffee for 75 cents.
Well, not at Starbucks or anything, but you could just get a standard cup of coffee at a restaurant.
They'll give you the straw.
Yeah.
You get the straw.
No, you don't get the straw with that. You just get the coffee.
You get maybe a smile from the barista.
Styrofoam cup,
Like a half smile, why'd you just give me a penny? Anyways. So today, we're going to kind of go through some of the methodology that we picked, because when the stock market drops, it's harder to pick good stocks because there are a lot of them. When the stock market is really high, it's difficult to... I shouldn't say it's difficult. When the stock market's really high, it's easier to find the bad players because typically people overvalue stuff based on what they're financially doing. And in the down market, companies, it affects everything. One stock goes down, they all go down. On that note, crypto is one of those things that have really gotten hammered very hard in the past few weeks. There's articles out there about people losing their houses. They put everything they had into crypto, and we are definitely not doing that. This is why you want to diversify. Buying one crypto and another one, that's not diversification. If you're buying nothing but telecom companies, or like AT&T, we buy Verizon, we buy all the other telecoms that are out there, you're not diversified. You're only in that industry segment. So when we talk diversification, we're going to be talking about different business sectors. So, AT&T is a telecom unit. There's pharmaceutical companies out there. There's oil companies. There's chemical companies. There's, so when we say food companies is another example. If we say diversification, you want to diversify within the industry and find 1 or 2 companies in that industry that does okay.
Right.
That way, if crypto goes south, you have other industries that do okay.
Yeah, it's not bad to be in crypto as long as that's not the only thing that you have. Is what we're saying.
Right, and don't put all, in other words, don't put all your eggs in one basket.
Yeah, it goes with stocks, with cryptocurrencies, with burying it in your backyard. So none of that's good. You want to spread it around.
Yep.
Reduce your attack plane.
Yeah, and it's also good to kind of have, an understanding of the industries that you're buying. There's a couple of well-known investors out there, Warren Buffett and the others, that have talked about, they don't buy technology stocks or something else because they don't understand them.
Yeah, I think that goes back to video 1 or 2, is buy what you know.
Yep, buy what you know. So if you're going to buy an industry or buy something that you don't understand, it's probably not a good idea until you understand at least a little bit about it before you invest in them. So this time around, we found, again, about 17 stocks. It was harder this time because, like I said, the market has gone down. The earnings for a lot of these companies was looking very good. Some of them were cooking the books. Some of them had a lot of write-offs from taxes that happened because of COVID. Some of them got grant funding. And you're talking billions and billions of dollars for very large companies. So sometimes you'll see stuff on their balance sheet that says unusual items. So this time, because it was harder, Brian and I both had to look at the balance sheet and cash flow statements. And during our last video, we said we're only going to pick the stocks that we understood based on what we talked about.
Liars.
And yeah, we weren't exactly forthright on that because now it's harder, so we have to get into some of the other aspects of these stocks just so people understand the method behind the madness.
So now we should talk about income and assets and liabilities on that.
We should. Income is obviously a good thing. You want to make money, not lose money. So when we're looking at the companies, we're going to show you the list in the next video, just so you understand what companies were there, which one we ended up picking. It almost came down to like a coin toss at the end. It's like, okay, these all look good. Which one really do we want? And we picked one in particular that we thought that would do okay as an income investment. Not as a, hey, you're going to buy this and watch the value skyrocket so you can sell it super high. It's very rare that, I mean, I don't know about you, but I don't sell stocks very often. If I buy them, I typically hold on to them for a very long time until their finances or the business model, or they do something stupid, or something happens where it's like, okay, now might be a good time to get out. There's a couple of reasons for that. So on the financial part, put that aside for just a minute. If you are going to buy low and sell high and you're going to do it before a year's time frame, you are not going to pay your capital gains tax rate. You are going to pay income rate. It's different, depending upon what kind of security it is, what kind of portfolio it's in. So again, we're not financial advisors. You're going to want to talk to somebody to make sure that you're doing this the right way. But if you buy a stock and you sell it before you hold it for a year, you're going to end up paying a lot more taxes on that stock. So that's why we tend to not do that.
Right.
So if you make $10,000 or $100 on a stock or whatever it is, it's a lot better to pay capital gains rates than it is income rates. So keep that in mind. That's another reason why, this passive thing of letting the money work for you instead of you constantly trading hours for dollars or working for it is a good thing. So back to the stock picks. This time around, like I said, it was very close. We had to get into the cash flow statements. We had to get into the balance sheet. We had to get into the income statement. Both Brian and I are looking at this, and with each company, all the market right now is down a lot. So each company doesn't necessarily reflect what the earnings are, which is why we had to go into that. So we'll go into it in more depth later on. But right now, what we're going to be doing is very generic overview so people understand the method behind the madness. Cash flow, first thing. You want to see positive cash flow. Kind of like your bank account. You show up to your bank account. If there is more money in there than there was last month, that's good. If there is less money in there, the net change in cash, when you look at the actual cash flow statement for these businesses, if there's less, that may not be bad because you might have invested in something. Maybe you bought a house, maybe you bought a car, because again, inflation and everything with taxes and everything, if you keep money just sitting there in the bank doing nothing,
earn 0.5%.
Yeah, that's not necessarily good, because I think the Fed is raising their rates to 8.5, that they're talking about 8.5 basis points by the end of the year. If they do that, then you're, because of inflation, they're saying 10% inflation, something crazy like that. If that actually is the inflation number, if you have $100 in the bank, by the end of the year it's worth 90.
Yeah.
So positive cash flow is good, but you don't want to hold on to it without doing anything with it for a long time because of things like that. And the Fed's job is more than just devaluing currency. So cash flow, what we looked for in all these stocks is we wanted to see that companies that were at least being responsible with their money, or they had a positive cash flow number. So we looked at that. The other thing we looked at was the income statement. This is pretty basic. You want to make sure they're physically making money.
Right.
Yeah, you pull up the income statement, you look at it, you can actually see what their net change in income or net income was over the course of 4 quarters or annually. Sometimes you have to dig down if annually it looks positive, and then you look in the quarterly. There was a couple of them on the list that annually it looked good, but then you look quarterly, negative, 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 for the last 4 quarters. Now the only reason why you didn't see it in annual is because it overlapped from their fiscal year end. So when you look at 2021, 2022, it looked good, but now you're looking at a stock that actually has a lot of negative earnings.
Right.
And it does show up in other places, like some of the stuff that we talked about with earnings per share, price to earnings ratio, diluted earnings per share, dividend yield growth, price to earnings growth ratio. There's a bunch of ratios that can reflect that. But from an income standpoint, the business is not making money. It affects all those ratios. So we had to look at the income statements quarterly to make sure that, they really are making money. There's a few on this list that are making a lot of money, which made it hard.
And there's a few that looked like they were making money, but they're more than likely selling assets.
Yeah, there was a couple there. Brian pointed out one of them in the stock that we were looking at. It's like, well, this news article said that they acquired this thing and they did this other thing with the acquisition, and that's where all the money came from. It's like, oh, okay, well, I guess that excludes that one. So we looked at income, we looked at the cash flow statements, and then we also looked at the balance sheet. I don't want to get into that too much because there's things called unusual items on there. There's a lot of things that on the balance sheet, when you're looking at it, can not really make a lot of sense. So for the sake of this video, we basically are just looking at the assets and the liabilities. Assets are stuff that you own. We talked about that in a prior video. So if you've got more stuff, those are your assets, the value or what they think the value of those assets are. One of the stocks in our list had an incredible valuation. I mean, they looked really good. Mm-hmm. And then you found out that they're saying their $100 asset was worth like $10,000. So it wasn't a good thing. So what we want to see though in most companies is a positive trend with their assets. We want to see some growth. Or if their assets aren't producing a lot of money, that they, in some cases they'll sell those assets for, other ways of making money. But you want to see a positive growth in assets, and you want to see that positive growth commensurate with the liabilities. So if you've got liabilities like debt, you want to make sure those are going down.
Right.
At least generically that they're going down. Some of the companies we picked have large R&D basically departments, so they have lots of liabilities based on that. If you're a defense contractor, a medical company, or anything like that, you're going to have a number of liabilities. Like construction industry has a lot too, typically.
Right.
I mean, there's a lot of stuff that goes into the machinery that paves your road, or builds your house. So that said, the companies that we picked, we had to pick one out of 17. That's not always easy to do, but it was the one that was generically the best. And how would you describe that? Like a coin toss at the last 3?
It was mainly, we played rock, paper, scissors to get the last 3 down.
Yeah, I mean, they're all profitable companies, and for a long-term purchase, pretty much the last 3 that we narrowed it down to, they're pretty good companies overall anyways financially. So it's not like you're going to make a bad decision by doing this. And if the market drops another 20% or whatever, or if it goes up 20%, that's not going to really affect the decision making process here.
Yeah, and if we would have picked any one of the 3, I think we would have been right.
So record that. Market goes down 50%. Well, we were still right. So that's it for what we've got in terms of the stocks that we were purchasing this time around. Do you have anything to add on that on the crypto side?
Crypto went down quite a bit. It's stable at the moment, so it's leveling off at least. So hopefully something will happen to bring it back up. But right now, at least it's not going down any further. Whereas Bitcoin's kind of holding steady at 30,000.
What's funny too is they trade almost identically to a tech stock. So if you're looking at your tech sector, crypto is almost mirrors it. it's like a brother-sister relationship somehow, even though
Right.
they trade it as like a staple good, and it's really not. It's more of a tech stock. The reason for that is most of their algorithms are based on blockchain, which is cryptology. So you're talking about software. So that's all I have for this video. We can actually get into the picks of the stocks that we did in the next video. So we'll highlight that then. And until then, thank you for putting up with us and watching the super exciting world of balance sheets.
Balance sheets, income statements,
Yeah,
liabilities, assets.
all of it.
That's fantastic stuff, man. Just gets me going.
It does. You know, there's people out there that make videos that make them super exciting. Maybe we'll find a way to do that at some point. But, you know, hopefully this is informational. If you like it, please like it, subscribe, because we appreciate that. Those subscriptions help pay for this, or at least help us make sure that we get paid for this at some point.
Hit that bell so you get notified.
Yeah, we appreciate that. You can comment all you want, except for the trolls. The internet trolls.
Now you can troll all you want.
Oh, they can?
Yeah, I don't read the comments, do you?
Maybe I shouldn't. Get all depressed. Some troll goes out there, that guy's an idiot, he doesn't know what he's doing. Oh, and then I get all sad.
Again, go back to the beginning thing that I said is don't worry so much about what other people think. So,
The thing that might make it to the video. We're not sure, maybe.
Maybe at the end. I don't know.
Until then,
Happy investing.